At Market Foolery is our Twitter handle from Tabo Hermanis in South Africa, who very nicely tweeted a story from The Economist entitled Blinded by the Light, and the subtitle is Two Big Potential Bankruptcies Cast a Shadow Over the Solar Landscape. We touched on one of these companies in a recent episode, and that's SunEdison, and the other is Abengoa, which is a renewable and engineering firm in Spain. And I'm curious because I know the solar power industry is one that you watch, and as an industry, it's had a pretty nice run, I would say, for the last 5 to 10 years in terms of not just results, but growing acceptance. Certainly some of the stocks have had good runs. And I think that for whatever questions existed about the viability of solar power before, say, 2005, I think you'd be hard-pressed to find a lot of people saying, no, there's no viability. So I think that, solar power as a viable power option, as a viable way to invest, I think those questions have been answered. Mm-hmm. That said, when you look, these are two large companies that are on the verge of just completely collapsing. And I'm wondering, when you look at a story like this, do you look at this and think, well, that's them, that's not the industry as a whole? Or do you think part of this story includes a cautionary tale for investors?
I think it's worth being cautious here. As we talked about with Tesla, similar to the story with Tesla, these are companies that are burning through cash and they have a good amount of debt. Anytime you have a scenario like that, there is higher risk for investors because these are companies, they're dependent on issuing stock, they're dependent on borrowing money to finance the business, and they're plowing through cash at a very rapid rate. So SunEdison, as an example, their operating cash flow last year over the past 12 months, negative $1.4 billion, capital expenditures of $3 billion. So that shows you they're burning almost $4.5 billion in cash each year. They have a net debt position of nearly $8 billion. So just taking a quick look at the balance sheet and the cash flow statement, you can get a sense for the position a company is in. SunEdison would not be able to operate their business without borrowing money. And that just in and of itself increases your risk as an investor. So I think when you're looking at a very promising and kind of a rule-breaking type of industry like solar, like obviously there's a big mass movement just consumer-wise and industry-wise when it comes to renewable energies like solar. You want to size any investment in your portfolio accordingly, especially when it's kind of these earlier stage or just really capital-intensive stage type of companies like SunEdison. And this goes for even a company like SolarCity, which is probably the most widely followed solar company here at The Fool. And as we've seen with the performance of that stock over the past year, it's going to be volatile. And when market sentiment changes for the worse, there isn't a whole lot of a bottom on the stock because there's no earnings. There's a huge amount of debt, no positive cash flow. They're burning through cash as a business. So you just have to recognize that these are riskier companies. Certainly when you're thinking in terms of potential of bankruptcy happening, it's higher with these kind of companies, and the share prices will be more volatile. So of course, it is kind of company to company. SunEdison, they tend to invest more in solar farms, so kind of closer to like the traditional utility model of generating electricity, whereas you have companies like Vivint Solar and SolarCity, which tend to be focused and concentrated on rooftop solar, which to me actually makes a little more sense just because you don't have to use any you can use existing real estate to produce solar with the rooftop solar model. You just put it on top of the roof and you're good to go. And Tesla actually also has a dog in this fight as well with the Gigafactory, which we talked about. So as these lithium-ion batteries become more and more affordable and more mass produced, potentially you can even cut out the traditional utilities. You won't even have to kind of plug into the existing utilities as we know them today. You could just have your own battery pack with your house that can store any excess electricity generated by the solar panels. So Solar City has mentioned that they think every solar system that they install within the next 8 to 10 years will have a battery pack installed. So that means each house that gets that solar system would have a battery pack. Whether or not Solar City is able to last as a business until then is another question. Whether or not that actually happens is another one. But that's certainly the direction that some visionary people in this industry see the solar industry heading, whether you're talking about Elon Musk or his cousins, the Rive brothers. So it's a fascinating industry, but definitely tread with caution here. I wouldn't make investments in solar an oversized position in a portfolio. It's going to be a very volatile industry, but on the plus side, even if you just have a small position in some of these companies like Solar City, a small position is really all you need. If solar takes off, or a company like Solar City takes off in the way that a lot of us here at The Fool expect it to over a period of 10 plus years, a small position is all you need. You don't need to load up on one of these companies to be rewarded as an investor.
Don't back up the truck on SunEdison.
No. Any company that's burning through cash at this rate, invest a smaller amount.